Doug, great to have you in the loop here. And before we get to what happened yesterday at the hearings, I want to get your reaction to what Paul Miller just said, which he said, look, this could be a one-year problem for JPMorgan. You agree?
I do, because there's been a massive reaction around the country and the world, and in particular, the political reaction here in Washington has been very strong. And as you know, there are potential investigations. This is pushing regulation in ways that will be harmful to the banks. And Jamie's just going to have to be talking about this for another year. It definitely will be hanging out there.
And yesterday, you saw the political divide on regulation among the Republicans and Democrats. You had Spencer Baucus sort of pushing back against his Democratic counterparts, calling for more regulation. And you side more with the Republicans, right? I mean, you believe that no regulation is really going to prevent things that have happened, like what happened at JPMorgan.
Yeah, I'm a political independent, and I've been a strong supporter of Dodd-Frank and financial reform. But I think the political reaction to the JPMorgan news has been very much an overreaction. $2 billion is a lot of money, but it's 1 month of earnings pre-tax for JPMorgan. It's 1/100th of their capital, 1,000th of their assets. Whereas in Washington, it's been a reaction almost as if, as Paul was alluding to, as if we were back in 2007, 2008. I think there are some lessons we can learn here as we find out more about what happened, but this is not nearly as big a deal as it is politically.
So what are the lessons, Doug?
Well, it is disturbing that perhaps the best-run large bank could make a mistake like this that had to do with not really understanding some quite significant positions. Now, we'll find out more when we get the details about what was being done and why and how it came to get out of control. But perhaps it'll be a little more reassuring than it looks now. But it's certainly not good news, and it makes it harder for the banks to argue that they have their risks under control.
Right, and it makes it hard to argue that bigger is better. I mean, you know, if it's overkill to talk about too big to fail from just this one trading loss, I don't think it's so much overkill to talk about too big to manage.
No, there's definitely that. But I have to say, it isn't that the medium-sized and small banks did particularly better in the financial crisis. So you can't look at our most recent experience of massive mistakes and say it was confined to the big banks. It just wasn't. The small banks lost their money the old-fashioned way, but they lost a lot of money.
Right, but you know, but they didn't jeopardize the financial system. I mean, that's what, you know, has got the lawmakers, you know, all in a tizzy about, is that, you know, if you broke up these banks into smaller entities at the very least, then they wouldn't jeopardize the entire financial system.
Well, I understand what you're saying, but do a little thought experiment. Think back to the crisis. Imagine that in advance, JPMorgan had been broken into 15 pieces and Bank of America into 20, etc. I think all those firms would have been doing the same things. They would have been massively overinvested in housing. They would have been dealing with these derivatives they didn't understand. They would have been doing all the things that led to the crisis. I'm not sure that too big to fail had much to do with that crisis.
All right, well, Doug, then what do you think is the next step? What do you think is the next step for Jamie Dimon?
You know, what he's doing. Basically, they have to explain better what happened. They have to keep making clear that this is nowhere near a life-threatening issue for JPMorgan. They have to get rid of some people, as they've been doing. I think they're doing the right things at this point, but it's a pretty deep hole to dig out of.